Preparing adjusting journal entries for the year end December 31st, 2011. You got to prepare adjusting entries before you can put out financial statements. And in this problem, they want you to assume, first of all, that prepaid expenses are initially recorded in asset accounts. That's very important to understand. When you bought something like insurance, rent, whatever, where you put it. Did you expense it first or did you put it in as an asset? In this case, they want you to understand that it was put in as an asset. Also assume that fees collected in advance of work, that is, you got money but you haven't earned it yet, where are they recorded at? Well, you could record them as revenues and then may have to make an adjustment that way, or you could record them as a liability, which is really the proper way, because until you've done the work, you have an obligation either to give the money back or to do the work. So that's the two assumptions we're going to work on in this problem. So our first adjusting entry will be depreciation on the company's equipment for 2011 is computed to be $13,000. You don't have to make any calculations. All you have to do is make the entry, and the entry is going to be a debit to depreciation expense equipment for $13,000 and a credit to accumulated depreciation equipment for $13,000. Next, the prepaid insurance account had a $9,000 debit balance at December 31st before adjusting for the cost of any expired insurance. An analysis of the company's insurance policy showed that $1,210 of unexpired coverage remains. So of this $9,000, we've used it all up. That is, we should have expensed it all except for this $1,210, which means that we're going to expense, make an adjusting entry to expense $7,790, and it'll be a debit to insurance expense for $77.90 and a credit to prepaid insurance for $77.90. All we're doing is we're moving the prepaid insurance we had from an asset to an expense, but with this entry. This is an expense that increases. This is the asset that decreases. Next, office supplies account had a $500 debit balance at December 31st, 2010. Now that was really the same thing as the beginning balance for January 1st of 2011. And $2,680 worth of office supplies were purchased during the year. So during 2011, they bought $2,680. They had a beginning balance of $500, and the December 31st, 2011 physical count showed $590 of supplies available. So we'll make a calculation. Start with the beginning balance, add what we purchased, subtract off the account, that is the ending balance, and that's how much we will expense, $25.90. So we'll debit office supplies expense for $25.90, and we'll credit the asset office supplies for $25.90. So again, same thing as this. We are reducing the asset account by $25.90, and we're increasing the expense account by $25.90 because it's been used up. Next entry. 1/4 of the work related to $11,000 of cash received in advance was performed this period. Now we said in the beginning we assumed that all cash received for work to be done in the future will be set up as a liability. So now we've earned 1/4 of this for this particular situation, and that's going to be $2,750. That's 1/4 of the $11,000, and we will reduce the liability account called unearned fees revenue for $2,750, and we will credit a revenue account, that is, increase a revenue account for called fees earned or fees revenue for $2,750. So we'll reduce the liability, increase the revenue account as we earn it. E. The prepaid insurance account had a $5,900 debit balance as of December 31st, 2011. Before adjusting for the cost of any expired insurance. An analysis of insurance policies showed that $4,690 worth of coverage had expired. They're telling you how much to make the expense entry for, because how much insurance has expired is what we want to reduce the asset and increase expenses by. So we will increase this expense account called insurance expense for $46.90, and we will decrease this asset account called prepaid insurance for $46.90. Finally, wage expense of $5,000 has been incurred but not paid as of December 31st. That means people work for us sometime during the last part of December, which was in the current year. We haven't paid them. We're not supposed to pay them until sometime in the very beginning of the next accounting period. Now, even though we're not going to pay them, we still owe it to them, and we want to show this as an expense in this current accounting period. So we will do the following. We will debit wage expense for $5,000 in this current accounting period to show that expense. We will also show wages payable as a liability that we owe these people as of the end of this accounting period. And when the next accounting period comes in the new year, we will credit cash and get rid of this wages payable expense, because we will be paying off what we owed then. But the expense still goes in this current accounting period because of accrual-based accounting.